Hi everyone. For this week's financial analysis, our group decided to learn a little bit more about American Eagle. American Eagle is an American lifestyle, clothing, and accessories retailer. This company was founded in 1977 and has their headquarters in Pittsburgh, Pennsylvania. A key sub-brand of American Eagle is called Aerie, which is an intimate apparel and lingerie brand. As we talk through American Eagle's financial analysis and ratio analyses, our group came to the conclusion that the company has good financial health that is in line with the retail industry, except its asset to liabilities ratio, and has shareholders that are confident in its ability to meet sales targets. Here's the breakdown of the ratios provided by MSN, indicating the strengths and weaknesses of American Eagle's performance in the 2020 financial year. As you can see, the current ratio was 2.08, the debt-to-equity ratio was 0.26, the inventory turnover ratio was 6.13, the gross margin ratio was 30.54, and the PE ratio was 17.54. So what does this all mean? Firstly, in terms of the current ratio, this is a little bit concerning. Not only is it higher than the industry benchmark, but it indicates that there are double the amount of liabilities than there are assets, therefore creating a greater probability of the company defaulting on loans, which is alarming for investors and stakeholders. Next, in terms of the debt-to-equity ratio, this puts American Eagle on the lower side of risk since they are not relying on debt to finance the company. They are performing significantly better than the industry average, which is $1.14 for every $1 of equity. In terms of inventory turnover, they are maintaining enough inventory to not be understocked. They are also performing significantly higher than their industry average in this area. In terms of gross margin, they're only a small percentage short of the industry benchmark, which is not bad, but they can monitor this area to find ways in which they could more effectively increase the ratio of profit to production cost. They definitely cannot afford to let this ratio decrease because then American Eagle will be losing money to production cost. Lastly, the PE ratio. This demonstrates that the company's stock is not undervalued or overvalued according to the industry benchmark. There are a few strategic decisions taking place at American Eagle to capitalize on their growth and consistent results in revenue. For example, in the transcript for the 2021 earnings report, the top executives discuss their acquisition of a company called AirTerra, a logistics provider that will provide key support as online sales grow and supply chain issues due to COVID-19 persist. Additionally, top executives discussed their continued efforts to expand into new markets. For example, American Eagle broke into the Mexican market and saw great results. Lastly, American Eagle's sub-brand Aerie has seen amazing growth and fantastic sales in the last year. They'll look to continue the focus on this sub-brand. Aerie is known as an intimate apparel company that's not only accepting of all bodies, but truly celebrates them. These messages of positivity and acceptance have paved the way for Aerie to become the go-to brand for intimate apparel. Stakeholders were concerned about American Eagle's high gross margin performance result being something American Eagle could not recreate. Making it the new baseline is a challenge because it leaves little room for mistakes as American Eagle tries new things that could potentially inflate the cost of production. However, American Eagle felt confident that their performance across the board was accelerated in comparison to 2019 statistics. They are surpassing old standards much quicker than they have before. It makes sense for stakeholders to be concerned about this new baseline, but hopefully American Eagle's confidence was reassuring enough to ease their concern about this new baseline. American Eagle indicated that they were more than prepared to deal with the holiday season. They even said they felt they would be more prepared than their competitors. American Eagle mentioned having a plan in place to proactively anticipate the effects of holidays during the pandemic. For example, they'll have extra planes on standby for shipping shortages and have already stocked up on key goods. This is a valid concern due to the fact that the pandemic has caused significant delays for everyone. However, the strategy of this company is to plan ahead, and the ratio analysis did not depict any concern for low inventory turnover rates or low gross margin rates. Here are some of the key documents that we used to create this financial report. Thank you so much for following along. We really appreciate it.